and welcome to our session on answering the question, how can you invest to support your mission and still pay the bills? Thank you for coming. I'm Paul Blyth, and my role here today is to chair today's discussion. I suppose I was asked because I've been working with investors for many years, helping them to shift from investing purely to make as much money as possible to investing to meet their financial needs and have a positive impact in the world. The purpose of today's session is to share knowledge on how, from both a theoretical and practical perspective, it is indeed possible to invest capital to both meet the financial needs of a charitable organization and further the mission of that organization. Something that when you get your head around it, it is difficult to see why all charities would not follow this path to a greater or lesser degree. As one bright spark mentioned, we all have impact via our investments. It's just a question of whether or not you want to own your own impact. A little housekeeping before we start. Please drop any questions you have into the chat channel. Please make them a question with a question mark and not necessarily a statement. So, who do we have with us to answer the question, how can you invest to support your mission and still pay the bills? Well, what a panel we have. I'd pay to listen to any of these people to talk for an hour, and we have 5 great speakers and we get it all for free. We have a couple of heroes. Danyal Walker-Palmer has been suggesting that perhaps the emperor isn't wearing very many clothes for as long as I can remember. And finally, the world is waking up to the fact that indeed the emperor is somewhat underdressed. Danyal, amongst other things, is the founding CEO of the Friends Provident Foundation and a leader and advocate for foundation to use all of their capital to support their mission. Amongst other things, the Friends Provident Foundation is behind the ESG Olympics, was an early investor in Snowball Impact, and behind the recent COP26 declaration on asset owner climate expectations of asset management. Our host, Rebecca, needs no introduction. But as well as running UFI, Rebecca is a hero like Danyal, as she has been able to steer her organization to use all of its assets to focus on mission, including its main corpus. She was also good enough to publish a case study on what UFI has done, so the rest of the world can learn from UFI's experience. Anecdotally, I've been told by a fair few people it's the best guide they've ever seen. Note that this is not a guide, and UFI is not offering any financial advice. Please take note of that statement, Luke. Luke Fletcher is the world expert on UK charity law vis-a-vis investment. He knows CC14 and the case law inside out, and in some ways has created, supported, challenged all of the advice/legislation surrounding this area. And it is also rumoured that he is creating his own case law on these matters. So I can't think of anyone better to help us understand the rules of the game. We are very lucky to have Luke with us. Paolo Fresia, where do I start and how do I make this quick? Paolo is an impact investor through and through. Not only does Paolo talk a good game, he also does it with his own capital. Paolo is a chief investment officer with tremendous impact investment capabilities. He has a background of working in the city/Wall Street and is very knowledgeable about investment, so brings genuine credibility to the investment part of this debate. Last but not least, Danyal Sattar, who, with perhaps one exception, has been working in UK impact investment in its various guises for longer than anyone that I know. He is presently CEO of Big Issue Invest, but prior to this, he worked as an impact investment director at Esme Fairbairn Foundation, Big Society Capital, and the Joseph Rowntree Foundation, to name a few. To try to touch on the areas that are likely to be front of mind if you're an asset owner or a trustee of an endowed charity or foundation, we're going to ask Luke about the law, Paolo about investment, Danyal and Rebecca on how you actually do it, and Danyal for some examples of impact investment. And then we're going to open it up to Q&A from yourselves. So Luke, imagine that I'm the head of an investment committee of an endowed charitable organization, and I've only ever invested to make as much money as I possibly can, so that I can maximize my grant giving. And that's all my peers have ever done, as far as I'm aware. And all that I've ever been told by my advisor that I can do. Surely this type of save the world investment is against the law, isn't it? Didn't Arthur Scargill and the Bishop of Oxford share a jail cell for not investing as much money to make as much money as possible? Luke, could you give us the lowdown on what the legal parameters are covering investment by charities in the UK?
Paul, thank you very much for the introduction and the question. I feel as if I need to go back in time a little bit to explain how you've put Arthur Scargill and the Bishop of Oxford together in a jail cell, at least in your imagination. I'm glad it never happened in real life. And if trustees act honestly and reasonably and prudently and take into account relevant factors and follow a good process and take advice where possible, a few caveats there, then they should be fine. And I very much doubt anybody's going to jail. But if we go back in time to Cowan and Scargill, that's the leading pensions case. And it's a 1984 case which involved the mine workers pension scheme, and Arthur Scargill, who is notorious as the leader of the National Union of Mine Workers at the time, who was leading various strikes and industrial unrest in order to advance the interests of mine workers. And he and a few others were appointed by the union to the board of the mine workers pension scheme. And the National Union of Mine Workers had taken this stance that they were not going to support overseas investment or investments which competed with coal, so the likes of oil and gas, for instance. And there was a deadlock on the board of the pension scheme for mine workers. And so a case was brought to resolve this deadlock, to try and understand whether that stance that they were taking was acceptable. And the court found for Cowan, who was representing the employer trustees, and against Scargill, who was representing the union trustees. And the principle that emerged from that case was that the trustees needed or were required to act in the best interests of the pension scheme beneficiaries. And in the case of a pension scheme, that means acting in their financial interests. And in turn, that means seeking the best risk-adjusted financial return that you can in the circumstances. And so that's the principle that came out of that case. And that principle still very much colours the landscape and is probably informing the imagination of quite a few investment committees up and down the country. But if we fast forward a few years to Harries and the Church Commissioners, otherwise known as the Bishop of Oxford case, which was a 1991 case, that was a charity case and is much more relevant and applicable to foundations who are considering impact investment. And in that case, Richard Harries, who was the Bishop of Oxford, brought a challenge to the Church Commissioners. And he essentially was arguing that the Church Commissioners ought to have a more ethical investment approach. They ought to divest more fully from apartheid-era South Africa and companies at that time that had exposure to apartheid-era South Africa. Now, the Church Commissioners had an ethical investment policy. It just wasn't as ethical as the Bishop of Oxford thought it should be. And so he brought this case, he sought declarations in the High Court with some others, but the challenge failed and the court refused to give the declarations that were being sought. And so it was, in a sense, a loss for the Bishop of Oxford. And at the time, it probably felt like a loss for the ethical investment community and those people who cared about society and the environment and the broader impacts of investments. But the court did say in giving its judgment that there were various circumstances in which foundations either should or could invest ethically and depart from this norm that you ought to seek the best risk-adjusted financial returns. And the examples that the court gave were examples where an investment might conflict directly with the object. So if you're, for instance, a cancer charity, investing in tobacco shares is not something you ought to do. You ought to divest regardless of the financial consequences. There might be other situations where investing in a particular way causes difficulties because it perhaps alienates donors or beneficiaries. And if that's the case, then you need to weigh up the pros and cons of an ethical, so-called ethical investment approach with a pure financial approach. And then there are likely to be situations where it is unlikely to lead to significant financial detriment if you're investing ethically, or for our purposes, investing for impact. And so those principles ended up forming the basis for socially responsible investment, or responsible investment, as we probably now call it, and in many ways set the scene for impact investment. But it's worth remembering that that case is a 1991 case. a generation has passed since that case was heard and the judgment given. And so 2 clients of ours are now seeking declarations in the High Court, and we're expecting a judgment next year, which will look at how climate change affects trustee investment duties. And our anticipation is that the court will say a few things that perhaps
I can't hear Luke. Okay. Right, okay. Perhaps we'll give Luke a chance to conclude later on and give his final thoughts, because I think that would be very helpful to us all. So we've been hearing from Luke on
guiding.
Oh, Luke, we lost you for 2 minutes.
I'm sorry, was it 2 whole minutes?
We lost you when you were mentioning that you have 2 cases going in the High Court seeking clarification, particularly on environmental aspects. That's when we lost you.
Okay, well, I'll try and shorten what I was about to say in that case. So the question that I think ought to be guiding trustees now is the question of which investment strategy is most likely to advance the charitable objects. That's the test set out in section 172, subsection 2 of the Companies Act, which applies to charitable companies. And that's very much likely to be the sort of test that the court looks at when considering the obligations of charitable trusts. I should say that some foundations will have permanent endowment and may have restrictions. And in that case, they will need to honor those restrictions. But I think the question is still how, in honoring those restrictions, are you most likely to advance the objects in carrying out your investment strategy? And I think if you ask the question in that way, that probably points you towards an impact approach, or at least thinking deeply about impact. And I think is the direction of travel we're seeing in the market.
Thank you, Luke, and thank you for being brief. Appreciated. So, Paolo, Luke's telling us that impact investment is possible, and perhaps the direction of travel and the new world that we live in now makes one think differently, in much more focused fashion on the objects of your charitable organization. So, if it's possible, you're an ex-investment banker. Surely we have to accept that when we make these kind of save the world impact, tree hugging kind of investments, that we're going to give up masses of money. Isn't that the case, surely?
Paul, yes, I love your provocative questions, and thank you for the question and for having me here today, and thank you, Luke, for teeing up the discussion beautifully. And it was really interesting to hear the origin of how now as trustees on Charities Board we can actually start doing impactful investments. So to answer your question, Paul, it really is the question, and in short, the answer is no. You're not going to lose any more money than in your standard portfolio by taking standard amounts of risk. But and actually, there is pretty good evidence that by embarking on a process of maximizing returns and impact, you actually might be able, as a board of trustees, to take on a more appropriate amount of risk, which is more commensurate, as Luke was saying, to the mission of the charity and the financial plans of the charity. Because most likely a charity is not going to be a pension fund with an indefinite endowment and just financial liabilities to the beneficiaries. There is actually a charitable mission. So I think there's a real opportunity to mitigate a lot of downside risk, like reputational, governance, climate, and also unveil new opportunities. And to me, all of these sound like factors that actually point to making better risk-adjusted returns than a non-intentionally deployed, non-impactful portfolio. Okay, so all of this sounds good, but also very theoretical. So I would like to give you an understanding of how do we actually do it on the boards that I'm on, and also what I did in my own family office. So first things first, if the goal is simply to align money with the values and the mission of the institution, one can just construct a portfolio with all the customized ethical screens and exclusions and ESG, environmental, social, and governance tilts to replicate exactly the same financial characteristics of a regular benchmark. And it can all be done passively if we want to limit costs. And there are many, many large banks or boutiques and consultants who now offer these services. We're very lucky. Impact investing has really evolved in the past few years. So these services are available. And all these people and institutions will be glad to respond to your request for proposal by creating a very, very elegant, values-aligned portfolio. And of course, to make that job easier, it will be helpful if the charity can articulate what these themes are by using a framework like the UN SDGs. So that's what I did with my portfolio by saying, okay, my 3 verticals are gender, climate, sustainable supply chains. At UFI, we rated the SDGs from closest to mission, such as education and edtech, of course, to furthest from mission, and so on and so forth. Okay, so constructing this type of elegant values-aligned portfolio is relatively straightforward from a financial point of view and doesn't cost anything more. But I personally would be really, really sad if the institutions that are present here today would only limit themselves to creating this type of portfolio. Because while being values-aligned might help everyone sleep better at night, and ensure, of course, that from a reputational and ethical point of view, we're not contributing to the problems that the charity is trying to solve, as Luke was saying. I think whether your portfolio has stocks or bonds that I can also buy of a company that does things that are good doesn't actually matter, doesn't actually create any additional impact in the outside world. And actually can maybe be a little bit of a distraction from creating real impact. And sadly, as a caveat, I should say, it has created plenty of opportunities for banks and advisors to charge through the roof with increasing their fees and greenwashing. So in a sense, I would tell you, yes, do it, align your liquid portfolio to your values, but do not overpay for these services when there is no corresponding value added in terms of financial returns, financial alpha. And so it's really important that you get on your board some trustees and advisors who can really guide you to help you navigate this space. Okay, closing the caveat here. I don't want to sound too pessimistic, but how do you actually then create impact? The first way is to engage. So engage with the companies in your portfolio. For example, to invest in funds that have a strong engagement policy on ESG issues. For example, a hedge fund called Engine Number 1 recently invested a large position into Exxon Mobil and then put new directors on that board. Is that, ethical? Does it make you sleep better at night to have Exxon in your portfolio? Probably not, right? But does it create a huge impact to engage with Exxon and turn it from a bad company to a good company? I'm oversimplifying here. Yes, that's huge impact. And I think that is something that we really need to be able to justify and be able to do. So that's engagement. The second thing I suggest to do, and I think that's probably the most important nugget of advice that I have for all of you today, is to really invest your institution's time and effort to truly understand your risk tolerance and your financial planning. For example, your investment horizon, your required returns every year to make your grant budget in the coming 5 or 10 years. Because too many institutions, in my experience, when I start sitting on their boards, are just not clear enough on their optimal level of risk, which is consistent with their mission. They just take the standard advice from their usual advisors and are sort of like trapped into this very prudential approach of taking what is often a suboptimal amount of risk, just in case, without actually running rigorous projections of their forecasted assets and liabilities into the future. And I think that prevents them from taking on the necessary risk to actually generate the highest amount of impact for them. And what is this highest amount of impact? It is not just aligning values and mission. It's not just engagement. It is actually contributing undersupplied and sometimes flexible capital with strong engagement with the underlying investments. Because you're not really contributing to the SDGs if you actually don't provide any money that others are not willing to provide, right? You're not contributing to the SDGs if you don't measure this additional impact and you don't report on it. And so these investments are usually private investments, think venture capital, private equity, private debt, real assets, they entail various higher degrees of risk, especially liquidity risk, right? But they also represent basically the only way an investor can actually have an impact. Because being riskier, of course, it is important that they're done with appropriate care and due diligence. But if you have that really good financial planning, it will give your institution the confidence to take on the right amount of risk and truly deploy these additional funds to impact. And for example, the way we've done this at UFI is to allocate about 20% of the portfolio to highly catalytic and highly mission-oriented venture capital. And we do these investments at UFI because we've calculated that the expected additional impact of an equity investment in some of these startups or a loan is actually higher than giving a one-time grant. So it makes a lot of impact sense while allowing us to make an expected positive risk-adjusted financial return. So by taking on more risk, in expectation, all standard portfolio theory says that you should also expect higher returns, right? And in my own empirical evidence, for what it counts, it's actually, all the impact portfolios that I oversee have been outperforming traditional ones. And I don't think that's a coincidence, not just because, oil and gas has been doing badly recently and healthcare has been doing really well because of the pandemic, but because by intentionally deploying assets and incorporating a wish to maximize impact as well as returns, I have seen that these really provides a better assessment of risk, a willingness to maybe change things up a little bit, change up your board, reshuffle your advisors, to actually trim costs once you really understand how much you're paying for things that are maybe not worth paying for. And in some, then provides better risk-adjusted returns. I hope this helps understand why I think you're not going to lose any money.
Thank you very much, Paolo. So other than, I guess, the advice to find yourself a Paolo for your investment committee, which is clearly the best thing you could do, a couple of nuggets there, I think, worth noting about engagement. And just as a heads up, and I imagine that Danyal may speak to this, and certainly we can speak to Q&A, there are organizations you can join which will do a lot of advocacy for you, because sometimes you don't have the energy or governance resources to do a lot of engagement, but you can choose managers, as Paolo has referred, who are good at engaging on your behalf, and or you can join collective groups that can advocate on your behalf. And also just great to pick up on some of the, again, get a Paolo, because it's amazing when you go through this, you actually get people to tell you what it costs to use their services. You can find out you actually end up paying a lot less money if you actually unpick the cost base. But thank you. And by all means, start putting questions in the comment area if things come up from a legal or financial perspective in your mind because of what we've just heard. So we've heard from the UK's leading lawyer that this is indeed possible. We've heard from an experienced investor that indeed it can lead, in some cases, as examples, actually to better returns rather than worse returns, which I think is the sort of the trope out there. But how do you actually do it? How do you go from A to B? How do you go from zero to hero? Well, luckily we've got two heroes with us today. And I'm going to ask Rebecca to start, and I know I've worked enough with Danyal. Danyal, just join in when you see the right point. You don't need any cues from me. But really, I think what it would be most helpful to our audience is just share your stories. Why did you make, how did you decide to make the change? What were the challenges? How was the transition? What was the experience like, and so on? I'm sure you can just share some thoughts with us. That would be really helpful. Thank you. So over to Rebecca first.
Thanks, Paul. Well, I think you probably can tell that one of the most important things we did, of course, was get a Paolo. But the interesting thing for us in terms of the journey we went on was that it started with a sort of a piece of inspiration. And actually, for me, the inspiration was Danyal, which is why it's so lovely to have her with us today. And to hear her talking about the fact that it was possible planted the seed in my mind about that really simple question. If you could do this, if you could get the financial return you needed in order for the organisation to deliver what we had profiled that we wanted to do, and you could do it in a way that had positive social impact, why wouldn't you? And starting with that question and exploring how it could happen, it became a series of initially small steps, and as we got more confident, they became bigger and more robust steps. And what we did was to seek as much advice as possible, to look for as many organisations that had done something that we were interested in, and talk to them about what they did and how they did it, and start to make some early decisions about how much resource we wanted to commit in terms of that engagement piece, and in terms of kind of where we saw ourselves getting to. But one of the kind of big fundamental, there were some big kind of catalytic moments that happened on that journey, and the first one of those was the hearts and minds piece for our board, to get our trustees to a point where they kind of made that decision and came to a realization that actually the legal framework did allow them to do it, and actually it would be a pretty good thing, because we have a relatively small pot of resources compared to global funds, and we should maximize the impact of those resources. And if you're just making grants with a small portion of it, but actually the rest of it beavering away doing something of which you don't fully understand the impact, then you're not maximizing the use of all your resources, and you are not going to achieve all the things you could do. And so that was our first kind of catalytic point. And then once we kind of collectively had our hearts and minds brought into the process, that allowed us then to use the frameworks that were available to us. So the SDG goals were really a really helpful tool to start thinking about, okay, well, what are the kinds of impacts that we would want to have in line with our mission? What's closest, what's furthest away, and how then do we go about doing it? And that gave us a framework to talk to our existing managers at that time, and it also then gave us a framework to start revisiting our investment thesis. But again, so the second catalytic point was we had the hearts and minds, we had our framework, and it became quite clear that the next thing we should do is to get some expertise around the board table that could help guide that journey and give the trustees who were in place at that point the confidence to proceed. And that's when we had the great fortune to have Paolo join us on the board. And from that moment, everything essentially sped up, because we were able to kind of really move at a pace. We had the framework we wanted. We had buy-in from the board and the organisation, and that gave us the confidence to have the conversations we needed to in terms of how we structured the request for proposals, how we kind of what advice we needed to take, and who we could work with to help us shape that advice. And actually kind of everybody that you see on screen at the moment has helped us shape that advice in some way or other, as we've, whether it be inspiration or some blood, sweat and tears for the process. But the critical thing about the conversations we had was that we were able to be very, very open with the people who we were asking for proposals from, about their kind of exactly what we were looking for in terms of our future cash flow projections and what we saw as the life of the organisation, and how we needed our investments to line up against it. So we were able to be open about our mission ambitions, and very clear about what we were hoping to achieve, and equally very clear about what we needed to achieve from a financial perspective. But I'm very conscious now that I am hogging the space, so I want to ask Danyal to jump in, because you have a fascinating story.
Thanks, Rebecca. I mean, and really pleased to be here. It's really exciting. This is a great panel. You're right, Paul. It's been fantastic already. I've been scribbling notes. But one of the things I think Rebecca has left out of her catalytic moments is actually the first one, which happened before discussions of investment or impact happened. It was really your strategy, because you were clear what you wanted to do as an organization. You had a strategy. And, this is, to me, in some ways, the kind of message I would say, first of all, to anyone even vaguely interested in this. What are you trying to achieve? What is the mission of your organization? I mean, we're mission investors. We are holding the money not just to hold it and make more of it. The objective is to hold it in order to do something. And I think from our perspective at Friends Provident Foundation, we started thinking about this probably in 2008, or before that, actually, before everything sort of went pear-shaped. Our beginning discussion was, I would say probably characterized by ambitious humility, because we had a huge mission at the time, which was to make an impact on financial inclusion. But then we were relatively small, as Rebecca, as VocTech is, relatively small compared to the problem. So we just thought, well, there's no way we can make any kind of impact on, no matter how carefully we construct our strategy, unless we throw everything at it. We need to be able to use every resource that trustees are entrusted with to make that change. And so it made absolutely no sense not to ignore our corpus, which is actually most of our money is invested. Most of it is not going out in grants. And I think that's probably true of most charitable organizations. Your endowment is most of your money. And I really would love to hammer home the point that Paul made earlier, which was, you are making an impact. Your money is having an impact. Your money is saying something about who you are in the world, whether you know it or not. And I think it is about owning it and about knowing what your money is saying. And it's really important that we kind of get that. And you can ignore it all you like, but it's happening regardless. And I think the other part, I think for us that I found fascinating, I'm really interested in how you've developed, Rebecca, but the points that Paolo was making about, what I would call the kind of shape of money. We have money of a particular that can do all kinds of things. It's quite flexible money. It can do all kinds of different it can act in different ways. And just being really aware of the kind of, first of all, the shape of the problem your strategy is attempting to solve. I mean, our strategy has changed, but our approach to impact hasn't. So we sort of recognize that actually we're trying to act in the world and we're trying to solve a particular kind of problem. We're using money to do it. And so just looking at the nature of that problem, you can't make all problems grant shaped. They just don't, the world isn't shaped like that. And you can ignore the problem and say, well, it's not grant shaped, so I'm not going to bother with it. Or you can engage with it and find out how you can shape your money to help you solve that problem. And I think as a foundation, currently our strategy is really about looking at how the economy can deliver, the economy can serve society better. That's a question, the big question. And again, we're tiny. So it's a big question. And we have been looking at that pretty hard for the last sort of 8 years. And one of the things we have learned is that we are part of the problem we're trying to solve. And I think recognizing that and thinking about how you can shape your money, your strategy, and your governance time to start solving that is been part of our journey. But Rebecca, I was interested in your governance. You see, I know Paolo is on your board, but I mean, does your governance change, like how you've approached, how you manage your money? Because you have sort of different structures within VocTech UFI, don't you? And I'd really love to hear more about that.
We do, because as you and Paolo said, the solution isn't grant shaped all the time. So we have our kind of approach to our core investments, which is our 100% for impact approach, and that's our governance structures relatively standard for that, in that we have our main board and we have an investment committee, and then we also make direct investments through venturing. And we have a venture committee that oversees that, sits under the board. But that's a much faster paced committee, if you like, because obviously the nature of direct investment is that it needs to be fast and it needs to be flexible. And also we have a much closer relationship with the organisations we support, and they are very, very at the absolute heart of our mission. And I think critical to all of that is the close relationship that there is between the team and the trustees in terms of we all have a very, very strong shared understanding of both the big mission and the kind of the sort of the very direct missions around the different investment strategies, and that's what helps to kind of maintain the pace and allow us to make good decisions and timely decisions.
Thank you both. Both fantastic stories. I echo the point that Rebecca has made about what a investment management consultant will call change management, the hearts and minds piece at the beginning. It's often overlooked. It is the most difficult thing to do, in my experience. And it's the one, if you don't get it right or you don't have a common understanding, you can put a lot of work in and go absolutely nowhere, in fact, backwards. So be aware of that. And then these two organizations, if you want to look at ways, as Danyal said, the shape of money, like how do you apply grant in certain circumstances and investment in other, and impact investment and mainstream and so on, and to meet the needs of the problem. Really helpful examples there. So we've covered legal, financial, and then kind of how do you do it angles. But what do you actually invest in? And what are some examples that might bring this to life? And I really can't think of anyone better than Danyal. Danyal, you've been making impact investments as long as anyone in the UK, before they were called impact investments. I don't even know what they were called when you first started. But can you share a few examples with the audience to bring that to life, if that's okay?
Yeah, I'll do my best. And I'm sorry, I'm on my second Wi-Fi network and second mobile phone network, and in fact, third electronic device to dial in with you today. So the gods are against us. So good news, people, you're already invested 100% for impact. It's just not the impact you might like. I mean, climate change has been financed. It's been meticulously business planned. So has the destruction of the tropical rainforests. It did not happen by accident. It happened because of our investment portfolios, because of our financial institutions. We made it happen. So you're already 100% for impact, whether you like it or not. So, and after 30 years of this stuff, I think every now and again, I do just get mildly peeved, as I'm no longer an angry young man. I just have to be peevishly middle-aged. So we're 100% for impact. If you want to be 100% for social impact and do some good, you can do it. You can go to your responsible investment portfolio management and say, please take that 10% of the kind of illiquid assets off the size of your fund. Do me a little fund that will give me an impact sleeve in there. But you can at least align. I think, as Paolo was saying, you can't get direct impact, but you can get alignment from a mainstream portfolio. There are social bond portfolios. Rathbones have one, and I declare an interest, the Columbia Threadneedle Social Bond Fund. We're impact advisors to that. That has social filters on the bonds that it buys, and there are also charity bonds in there. So you can do that. Big Society Capital have got a fund with Schroders. It's a trust, it's live now, it's daily traded, I believe. So you can be in there now. We're not one of the organizations that it invests in, so I have no vested interest in it, but it's actual, real, genuine, live impact investing today that you can enter into. You can open a bank account, Triodos Bank, Charity Bank, Unity Trust Bank, Ecology Building Society. It's one of the simplest things you can do. Just move your cash. In fact, actually, opening a bank account is absolutely hellish. It seems to be really easy if you're an international drug runner and money launderer. But for those of us who use bank accounts for ordinary, sensible purposes, we have 26 of them in our organization, and it's hell on earth opening bank accounts. But you can open a bank account, move your money, you can do that. It's really straightforward to do it. Then you come to the likes of us, illiquid, direct impact investing. 100% of what we do is invested in charities and social enterprises, in our case, here in the UK. There is Resonance, there is Social and Sustainable Capital, and of course us at Big Issue Invest. We will all quite happily take your money, invest it, and we can give it back. I can't give you a future-looking projection, can I? But I can say on our first social enterprise investment fund, we're looking at it today, and when you add up the 98.5% of the money we've already returned to investors and the cash sitting in our investors' bank account, we've got absolutely positive give back of money from investing in charities and social enterprise in the UK. So you can absolutely invest for impact. You can absolutely invest for positive impact. And please be aware, you are already investing in impact. So please choose to invest in the better impact rather than the other stuff. Thank you.
Thank you, Daniel. I think if you're no longer young, was it angry young man, you're a grumpy old man. I don't know what the middle one is, but thank you for sharing all those great examples. And you can actually invest in every single asset class to a greater or lesser degree for impact or values alignment and so on, as has been described. The opportunities are there. So we've heard about the legal, we've heard about the financial, we heard about how do you do it, and then we've heard about some examples of how you can do it. And now here's your opportunity to ask questions. So I would encourage you to, I think the way to do it, as far as I understand, is to write in the comments box if you have questions. So I have lots of questions, as you would expect. The one that I'm asked a lot, and I'm going to put Paolo on the spot, but anyone can jump in. I get asked this a lot, and people say, well, Paul, basically, as far as I can see, every single asset manager, consultant, financial advisor that used to not be concerned about these matters at all is now a world expert at it. How do I somehow, in my pro bono, part-time, non-executive role on an endowed charity, somehow sift between those that really kind of know what they're doing and those perhaps that aren't so good at it? How do you approach that? It's quite a tricky question to answer.
Thank you, Paul. That's a really good question. And my first answer is probably, as a trustee, get a really good independent consultant to advise you on this. And independent is key. So someone who does not manage money themselves, but who truly can give you that independent perspective and judgment on the landscape. Because the landscape of impact investing is evolving so fast that it's really impossible for any of us to keep abreast. And so paying a little bit of money for a professional to do that goes a long way. But the second, answer that I can give if you want to do a DIY approach is really to think in the terminology that I'm borrowing from a think tank called the Impact Management Project, which is this investment just avoiding harm? Is it benefiting some stakeholders, or is it actually contributing to the solutions? And for me as an investor, as I was saying before, am I just buying stocks and bonds that anyone can buy, or am I providing some undersupplied capital that no one is giving? Am I providing some maybe more flexible capital? And when you're tending towards more contributing to the solutions, and when you're tending towards more like, oh, no one is giving this money, maybe I have a role to play, then maybe that investment manager that you're evaluating is someone, from an impact perspective at least, worth having a look at. If it's just a very glossy report with a lot of nice figures from a relatively mainstream bank, start getting a little bit doubtful. But I'll stop there. Maybe someone else has some nice ideas.
Thank you, Paolo. Great advice. Danyal, I don't know if there's anything you'd like to add.
I think what I would add to that, and I think those are absolutely the right things. Usually, I'm always very suspicious of like lots of smiling children in any kind of brochure. It's always like, not that I don't like children, I just sort of wonder slightly. Anyway, but I suppose one of the things we found invaluable and probably where I kind of first met Paul was actually in some of the supportive structures that are out there. Networks of other people who are seeking, who are looking for how to do this, because I think with a lot of impact investing, especially when we started, and I think and Danyal used to convene one actually, and it's like basically the emperor had no clothes, and particularly, to be honest, no one had a clue what we were doing. We actually just felt this was the right thing to do. And we were trying to approach the management of charitable money in a sensible way, but we also recognized we actually, there were other people also feeling their way. And as that wonderful probably apocryphal African proverb, if you want to go quickly, go alone. If you want to go far, go together. And I think that is something that certainly exists for charitable organizations. So the Charitable Responsible Investment Network is a fantastic network for people with their mainstream in portfolio. Is run by Share Action. It's essentially a network. It's actually growing and growing and growing. We were very early in the door, and thank goodness, because we've really shared the learning. We've learned from others. We've shared our learning with this big group of foundations who were essentially trying to work out how we can really make our mainstream portfolios work harder. The managers we use, understanding the voting patterns, really the kind of stuff that's really hard to do on your own. It's really fantastic to do together. So collaboration is absolutely key. And I think another thing is the other one is the Social Impact Investors Group, which I think Danyal, you probably founded it back in the day, and certainly Paul and I used to go along and basically fangirl and boy Danyal, but you learn a lot. You get to hear from lots of different kinds of initiatives. They may not suit your mission, but you really learn from your colleagues about the questions they ask. And I would really just come along to those. That's now hosted by the Association of Charitable Foundations, and anyone come along and you can just like listen and work out, what's going on in the field, what kinds of issues are out there. It's really helpful. So those sorts of structures are so helpful just to kind of get under the skin of what's going on and really make sense of what you could just basically call greenwash, which is out there. It's definitely out there.
Thank you, and thank you for those references. And we will, I believe, following this, we're going to send out a note with some useful resources for people. I have a question from Edward Garrett. How do the panelists view the potential and current availability of blended finance structures? Does anyone want to put their hand up to respond to that question? Okay, Danyal, give it a go.
Yeah, I can give it a go. It's Access Foundation for Social Investment have led the way on this with the National Lotteries Community Fund. They provided a blended finance layer alongside Big Society Capital, and a good many of us in the sector, Big Issue Invest included, have been able to make, I think we've pushed out around £10 million of access money through 2 different rounds using this blended finance approach. And it's a flexibility that's been I think it's been great for financing small to medium-sized charities. It's also something that's more common outside of the UK than in the UK, it seems. We haven't quite yet pieced together how to put in these loss layers that lever in other investors to create these big pools of money. But I'm really hopeful now. The British Business Bank have changed, this is all the boring stuff, but they've changed some of the technicality around their guarantee scheme, which means it's more applicable to us in the social sector. So I'm kind of hopeful that we can use some of those government streams to perhaps replicate something that we call blended finance in other countries here in the UK.
It is a very, and thank you, Edward, for the question. It's a very interesting area, and sort of borrowing from what Danyal said earlier, the shape of money. It's quite odd. You can find situations, particularly in the developing world, where an investor or an entity is like desperate to, let's say, leverage the impact of their capital. That's what they're about, and they're particularly focused on a particular area. It might be financial inclusion, for example. And so they can put their $20 million to work, but even better if they can invest that 20 million in a $500 million fund, but take first loss risk, which enables a whole bunch of other investors that would like to invest in a structure, but can't do because the risk is too high. And so I think when you're a charitable investor, again, the shape of money and it's not always the grant is the answer. Be aware that there are a number of ways that you can deploy your capital for, to maximize financial returns. And, you can give grants, you can do blended stuff, you can go into structures, all sorts of ways to look at this. And I think if you maintain at front of mind, what is my object, what is my strategy, what am I trying to achieve, and how does that fit within that construct, you can actually do a lot of things with your money. It's very flexible. We have another question. This one's from Louise Rowland. Does the panel think that charity regulations will evolve and require charities to do more social impact investing? Luke, I'm going to put you on the spot for that one.
I had a feeling you might call me in on this. I think the law and the Charity Commission are very much likely to respect trustee discretion and the exercise of trustee judgment. So trustees ultimately need to make decisions about what's in their charity's best interests, and those judgments will involve consideration of a wide range of different factors, and different boards will come to different decisions. And so I expect that the court will say as much next year. We obviously wait to see, and I expect that the Charity Commission's regulations and guidance that follow will say as much. But at the same time, I wouldn't be surprised if we saw perhaps a change in emphasis, a change in the sort of tone of the way that the Commission communicates, the way that the court describes these issues. Because if we go back to that question of which investment approach, which investment strategy is most likely to advance the object, I think if you were to ask that question 30 years ago, you would have got a very different answer to that question than you would today. And the world is moving so quickly, it's becoming, I think, increasingly hard to ignore the negative impacts of investment activity when you think about deforestation, pollution, the climate, and inequality. And at the same time, people are much more aware of the range of positive impacts that are available, and of foundations doing this, and of investment managers and others coming into the space and offering things, and the market generally growing. So you put all of those things together, and I suspect we will continue to see a shift, and I'd be surprised if we didn't see a change in tone and emphasis.
Thank you, Luke. Something I picked up, I think it was a Rebecca statement, so I'm going to put you on the spot in a moment, Rebecca, but it may not have been. But I thought it was a useful phrase when approaching these situations, which was, norms and normal are not necessarily the same thing. And if that was that a Rebecca? No, sorry. Okay, perhaps I'll put a bit more color on it then, and then ask the panelists. And I think it's about, but you did refer to asking the question, just because everybody does something, i.e. it's a norm, does not actually make it kind of sensible or normal. Right, because of all your peer group, all they've ever done is to invest money to make as much money as possible to maximize grant giving. Doesn't necessarily mean that's the right thing to do. And it's the ability, I think, to step back from the norm and just ask the question, because often you're quite surprised by some of the answers that you receive. I don't know if any of the panelists want to talk to that.
I was just going to say, I think that's right. And I think it's also challenging your own normal is also quite important, because we've been around a bit longer than VocTech. So we've kind of had to go back through and go, this is interesting. We've been saying we want to be an engaged investor, and we want to behave in this particular way. And then we looked at our own practice and realized that we were actually spending probably the same amount of time as most charitable trusts do on investment, which essentially you see your investment manager once or twice a year. You have them around for a bit of the meeting time, but you've got other work to do, and you spend a lot of time on grants, loads and loads and loads and loads of time and resource on grants, but actually relatively little on the investment side. And we suddenly realized that actually it didn't actually make a lot of sense. So we challenged our own norms and sort of went, I think we need to rebalance our governance and staffing time to actually reflect our own objectives. So I think it's looking at what you actually do and how it relates to your actual strategy and what your aims are, which is really kind of important, and just being prepared to change it.
I would agree with that, and I also think that it comes back to Daniel's point about you're having an impact anyway. You just have to decide what that impact's going to look like. And the minute you kind of switch your thinking from, oh, the money's just the money and it's the engine that drives the grant giving machine, and the minute you think about it as actually being that it is doing something, then you have to think about, okay, well, how do we put the time and effort into understanding what that something is, and what do we want that something to be, and how do we make it fit with who we are and the mission that we're trying to achieve.
Thank you. Just to quote, I'm going to misquote lady called Clara Miller, who ran Heron Foundation many years ago, and she described, this is a US context, she described charitable foundations in the US as basically hedge funds with a sidecar that gave away 5% a year to charitable causes, which I thought was an interesting perspective. We have one question, and then I'm going to wrap up because we're going to run out of time. This is from Maureen Furtis. As impact-focused investing becomes more mainstream, what would you, the panelists, like to see happen in terms of new structures or investment vehicles? Does anyone want to have a pop at that? Paolo.
Thank you for asking the question, and I think it ties in really well with also the previous question about blended capital. And in terms of challenging norms, I think what we should do as trustees and managers of charities is really to also not wait for those structures available if we think that we can fill a gap and actually achieve some impact. Speaking of blended capital, for example, at UFI, we have a continuum of capital from grants to loans that are repayable, to loans that are actually covertly or not made from our grants portfolio in terms of risk, to venture investments, to our corpus. And so that way, we really can already de-risk investments without having a vehicle, but knowing that we are actually helping other investors make better investment decisions that they are able to do out there in the investment landscape. What I would like to see, coming back to the question about new structure investment vehicles, when those actually come about, I'd really like to see them tying investment incentives and rewards to impact metrics. And I think here in the UK, the ecosystem has been pioneering this with the likes of Bridges, for example, with their social outcomes fund, where literally investors like me get repaid only if the investments achieve their impact objectives. I mean, that is fantastic. I would like to see more and more of that for any asset class.
Thank you. Luke, I think you want to say a quick word before I wrap up.
I think the point I would make is similar in some ways to Paolo's point about incentives. I'm very interested in the incentives that boards of companies have and the outlook that they have. And I think that we ought to be thinking more about embedding revised purposes within corporate constitutions and requiring corporates to seek a positive impact. And that's part of a campaign that we're running with others called the Better Business Act campaign, suggesting that the law ought to change on this. And personally, I think that's the next frontier. I can't really see that we'll have a world where we have a sustainable and inclusive economy unless the law requires it.
Thank you, Luke. And I'd refer you, if you do work within the corporate world as well as the charity world, there's a great study done by the Durham University Business School. I'd say if you would pay a mainstream consultant about £1 million for it, it describes how to embed essentially the SDG and purpose into your business planning if you're a major corporate. My quick answer to that question is I think probably, I hope where we're going to go is that corporate debt issuance, because that's how corporates raise money these days, is actually not through equity, will have ratchet mechanisms related specifically to impact targets. And they will pay less money if they achieve the impact targets and more money if they don't. And that's how we'll see significant change in the corporate sector. And that's been done by impact investors in the municipal bond market in the United States, and it's pretty exciting. I.e., if you're running a major corporate and you want to borrow your money cheaply, you got to basically be clean, green, and social, and you'll get cheap money. And if you don't, it's going to cost you a lot more, which I think is great. We have run out of time. I will close. Thank you, of course, for joining us today. My understanding, well, I hope is that this has been helpful to you, that it has been of interest, and that if you'd like to learn more, my understanding is this has been recorded, so you can please do share it with peers, watch it again if you'd like to. There are a number of organizations that have been mentioned, which are maybe helpful to you. The Social Impact Investing Group, or SIG, the Impact Investing Network, the Charities Responsible Investment Network, CRIN, to name a few. And my understanding is there will be an email following this session, which will include a video, contact details of people on the call and their organizations, and links to other resources. And I'd like to finish by obviously thanking our panel for giving up their, well, for sharing their knowledge and expertise pro bono and for the greater good. I'd like to thank our host UFI, particularly Rebecca, of course, and to end with what is fast becoming a famous quote from the apocryphal Greta Einstein. If you keep investing in the same way and expecting different results, then you're only fooling yourself. And remember, there is no planet B. Thanks, everybody. See you anon.
Thank you.